Good afternoon, and welcome to the third webinar in our Capital Readiness Resource Series. My name is Samuel Wiggins, and I'm the CEO of Virginia Minority Chambers, the host of this series. We are a statewide 501c3 nonprofit organization with the mission of supporting minority chambers of commerce and the businesses they serve. We do this through advocacy, education, and programming, like today's webinar. This series is focused on capital readiness because access to capital is the number one problem faced by small and disadvantaged businesses, especially new entrepreneurs. Our webinars will introduce you to the different funding opportunities available to your businesses and provide experts that will show you the path to success. Today, our presenter is Darryl Appiah. Mr. Appiah is a loan officer with over 10 years of experience in the financing and banking industry. He has a proven record of excellence in customer service and relationship building. He is committed to helping small businesses find the financing that's just right for their needs. But before I turn things over to Darryl, a little housekeeping. If you have any questions during the course of this presentation, please feel free to hit your Q&A button and type it in, and they will either be answered during the presentation or immediately after. Also, you see that you have a reaction button. Feel free to show your appreciation at any time. Now, let's give a warm welcome to Darryl Appiah.
Thank you, Sam. Thank you for having me. I'm very happy to be here, and hopefully you all take from this presentation, whether you know some new things, it could be a refresher of these things, if you've kind of already had a little bit of knowledge of these, but really, just the whole overview of this presentation is to try to get you all to see things through the eyes of a lender. Just from a general standpoint, the things that, you can prepare yourself or do if you are in that early stage of entrepreneurship and in needing some funding to kind of get you to that next level for starters. Again, just a little another intro. I'm Darryl. I work for Momentus Capital, which is a community development financial institution, which does specialize in an array of services that pertain to the access to capital. So we are not a bank or a traditional lender. We are a nonprofit organization, with partners with different organizations to assist in the lending folks for community development lending, real estate, and obviously small businesses. We are SBA-backed lenders, and we are nationwide. I am located in the Northern Virginia area, but I covered DC, Maryland, and Virginia, as well as in Atlanta, but pretty much for the most part, all of the East Coast, but I'm not limited to doing the other 48 states that we do cover. So without further ado, I'll go ahead and get started. So for today's topics, we're going to cover just really the types of loans and really put a heavy emphasis on the 5 C's of credits. And this is kind of the bread and butter of what really goes into the assessment of a good quality candidate when seeking a loan. So we're just going to really highlight, throw a few pointers out, and really just give general insight on what it is that lenders tend to look for to assess you to be a capable borrower. All right. So for starters, as we all know, the economy isn't the greatest. I mean, it hasn't really, we've kind of been trending upwards, obviously coming out of a global pandemic. A lot of businesses took hits. Anything that obviously dealt with any in-person activity, businesses were shut down, profits tanked. I mean, you name it. So I will say it isn't so much of an excuse anymore, being that we're 6 years removed from that, and the lending industry has pivoted since. But just a little history since 2020. The pandemic did bring a lot of inexpensive and free monies, and there were a lot of programs that were injected and trying to assist you guys. I'm sure everybody remembers the PPP loans or the EIDL loans. But then just the public perception around pricing and capital access changed as a result of that. A lot of folks, it was made easier back then to really kind of get us out the rut that we're in. And now that things are a little bit more stabilized, it's tricky for a lot of folks to really kind of wrap their heads around what is now versus then. So current challenges we're seeing, obviously rising rates. Prime went up 5% in 4 years. This is a little bit outdated because Prime has dropped since then. I think right now it's at 6.75, which is good and trending downwards. So that is good news at least. But because of the tough times that we endured, or most business owners or borrowers endured, a lot of borrowers have exhausted their creditors. Now we're seeing a lot more high revolving debt with limited liquidity. Lenders have tightened their credit box, so they've just made things a little bit more. I don't want to say challenging, but they've just kind of gotten a little bit more strict or lessened their leniency when assessing deals. Obviously, supply cost increases, inflation, always something that we're going to have to worry about. We had the whole pterosaur deals about a year or a year and a half ago as well. So a lot of customers needing goods, or a lot of businesses needing goods overseas that was impacted by the rise in tariffs, etc. So obviously, the result in all that was harder for lenders to find qualified borrowers amidst all these challenges and current market trends that took place.
Hey, Darryl, I hate to interrupt. Can you share your screen, your presentation with us?
Oh, I'm sorry. I thought it was already shared. I
No,
apologize.
no problem at all.
Um,
It's great seeing your face, but we want to see your information too.
let's try this again because it showed up on mine, so I thought you guys all had did something to make it accessible for you all. All right. How are we looking?
Look great.
Sorry about that. All right. So, yes. So this is the slide that I just went over. And then as you can see, just kind of the economic outlook. Obviously, we're only 2 weeks into the new year. Not a whole lot has changed. We did endure the government shutdown about 2, 3 months ago. So that definitely impacted our ability to help as well in the startup space also because we are being SBA backed lenders, Small Business Administration. If the government shuts down, they're ultimately shut down as well. So these are the areas of evaluation that lenders obviously look for. And then I'm going to obviously elaborate on this a little bit down the road. But credit, cash flow, as we all know, cash is king. Sometimes well, most of the time it takes money to make money. Capital, collateral, and experience. And then individually, we look at each borrower's situation and see how it affects their capacity to service additional debt. All lending is risk management, right? It's finding out or seeing that or seeing the ability to tack on additional debt. What I like to tell a lot of the clients that I work with is as long as you're able to service the debt that you already do have, in addition to the debt that you wanted to tack on from us, you have a shot. Because at the end of the day, as a loan officer, we don't want to put nobody in a bind, right? We do our cash flow analysis and we just want to see that us giving you another 20,000, 300,000, 50,000, whatever the number may be, it's not going to hurt you, even if, you're right at ends means and you think you have a little bit of leeway to tack on another debt. If it doesn't make sense or if it's going to make things more difficult for you, you might find it a little bit challenging, for the lender to want to feel comfortable awarding you that because it goes back to not wanting to put you in a bind. These here are traditional loan terms, just the different types of loans. Everyone typically HELOCs or something that people are usually familiar with. It's a home equity line of credit, a line of credit against equity in personal real estate or a commercial asset. Typically interest only for a period of time and then converts to P&I for a set term. So anytime you see line of credit or credit lines, think of it as a credit card. So revolving debt is another term that is used for that. You essentially are given at a certain amount for you to have access to, and you pay back what you've used plus interest, or obviously there are different promotions where there might be interest-free bearing, and you won't have to cover that, but it typically converts to P&I after a certain amount of time. Factoring, not going to cover too much. This is a rare, it's very basically it's a cash advance against account receivables. So almost think of it like IOUs. You're drawing off of monies that's due to you. So this is interest that's paid on time for an invoice to be paid. And the rate is obviously based on turn time and vendor credit. Conventionally loan is any loan that is not guaranteed by the government. I work for SBA-backed loans, so all my loans are personally guaranteed. And then equity is more so the self-funding route, against a percentage of ownership or selling stock. And let me see. And then obviously government guarantee provides a guarantee to a lender based on a certain guidelines. For SBA-backed lenders, we have to follow the SOPs or the standards of procedures for the SBA, meaning we have to be within their guidelines in order to lend you. All the SBA does for SBA-backed lenders is kind of serve as an insurance policy for bankers, hard money lenders, CDFIs. A lot of folks tend to think that the money is coming from the SBA, but that is not the case. They only guarantee up to 85% of the money that the organization is giving the borrowers. In the event that the borrower is to default on it, we can recoup some funds from the SBA. So that's how it works. Not gonna harp on this topic a whole lot. Obviously, we all know for entrepreneurs, if they do have the capability of not having to go get a loan, they will, kind of go the bootstrapping route and go the self-funding option. Here listed is an option that a lot of folks aren't really familiar with, but it is more complex and not highly recommended, but it's a ROB. So it's a rollover as business startup where the borrower could use the retirement funds to finance the business. And ultimately what that means is they will form a C Corp using their 401k or IRA, and then or well, vice versa. They'll form that C Corp and then use that 401k that was already existing and roll over those funds into purchasing that company's stock to cover whatever operating expenses they might have or any startup costs that they might have. Now, this is privy to a lot of tax penalties, or it's very complex in terms of what really goes with it. So a lot of times too, organizations that see that you already started with a ROBS might not even lend to you because they've seen that you've already dealt with this. And just I know for my company in particular, we just don't have a good grasp or understanding in our credit departments as to what all goes into it due to a lot of the tax implications that are involved when it comes to this. So just want to throw this out there in the event that you are to see this term anywhere. But again, it's very complex. And it's probably your best bet to you talk to somebody in this space to get a little bit more understanding over it if it's something you want to dive into. But it is another self-funding option if the access to capital is hard for you to come by. I went over this a little bit earlier. These are the types of loans. You have the term loans, again, P&I, principal and interest payments over time, termed out over a specific time. You get the funds, you have the X amount of time to pay back. There's interest there. Every now and then, some of these institutions will tack on a prepayment penalty for paying it off too soon. Usually there isn't. And then again, you have your lines of credits. Interest paid on outstanding balances, and balances can be drawn down or repaid over the life of the line, typically renewed annually or over multiple years based on certain credit conditions. There you have your merchant cash advances. Similar to, as I explained earlier, it's just an advance on future credit received from the customers. And typically, MCA loans are more predatory than not because the rates are through the roof usually. They are easily accessible. So typically the MCA organization's targets demographics are folks who are desperate, so to speak. Because again, they can approve you on the spot, give you the capability to have the capital you need right then and there. But at the same time, again, these rates are sky high. Think of it as getting into a very bad car loan sometimes. It's gotten to the point where effective June 1st, the SBA won't even refinance these special loans, these type of loans, just because borrowers that show a history of accessing these type of loans tend to do it repeatedly. because it's easier to come by. And that's kind of how they look at it from a character standpoint, which is one of the C's, and I'll be covering later. These are the type of loan programs that are traditionally offered. Again, you have your SBA loans. 504 dabbles in the real estate space. You can use a SBA 504 loan to secure a commercial property owner occupied. And then you have your 7A loan, which is what I work in. And these are both federally loan guarantee programs, reduces the risk to the lender and allows them to make loans to a borrower that does not meet conventional loan requirements. Again, the SBA loans were designed to give that business owner that leniency, essentially make it a little bit easier for them to come by. But as again alluded to earlier with the economic climate, it has been a little tough, but it is still a good alternative option versus going to the bank to get a traditional loan. Then you have your microloans still there, could fall under the 7A bracket, but there's just a reference to the loan size. And then these are loans that, nonprofit organizations or community organizations can make because of that. The ability to give out small amounts, it's kind of similar to grants, just under certain terms, gives us a wiggle room to do that, or gives organizations the wiggle room to do that. And I've listed, again, just a CDF5 because a lot of folks aren't really familiar with that type of organization. Typically, they're mission-based. So, they have their target areas or demographics that they want to assist or give that essential boost to. And it's just programs that promote access to capital like we're doing here. So we'll say Momentus Capital is, we are the nationwide leading lender in the 7A Community Advantage Loan, which is the project that we have. Excuse me. So with that being said, we are not limited to a lot of the type of businesses that we see. Our bread and butter is startups, so we have no revenue requirements. We lend a minimum of 30,000, and we're capped at 350K. Some other lenders have a higher threshold of lending amount. So while we can only give out 350,000, there may be other organizations that could do a little bit more. So it just does depend, and really understanding the lender and their credit box and what goes into it. And I'll cover more on that later. We'll go to the next slide. So how you plan to use your money matters. And really understanding that, my role as a loan officer is kind of really to serve as the middleman between you and the underwriters. They are the decision makers. They're the ones that are going to approve or deny you. My job as the quote unquote gatekeeper or is really or your advocate is really to show that you're a good deal or a good candidate again for underwriting and get you to the finish line as fast as possible. So I say all that to say, understanding what goes into your business is important, because if you don't know, well, how do you expect to explain it to underwriting for them to understand it? Because we're only going off of what you say in addition to the financials to back it. So obviously, if you're using your money for business acquisition or change of ownership, really understand the percentage that's going to go into it, what's going to entail as you take on that new role, equipment, keeping tabs on invoices, maybe shopping around and doing your homework in terms of getting the best bang for your buck, refinancing debt, as I briefly touched on before. If you happen to have fallen into a bad loan and you want to jump into another one to maybe consolidate at a better rate, that is totally fine. Fortunately, it can't be the MCA debt. But if you were in a good position, you kind of needed something to get you out of a rut, and you took on a little bit bad debt at a term that wasn't so favorable, it's not the end of the world. And then, you seek another lender to maybe refinance that is fine. Working capital is the most popular loan usage or loan proceeds that we see. It's a little bit more on the vaguer side, but it's typically meant to cover any operational expenses of your startup business or your business in general. Rent, payroll, insurance maybe. So things of that nature. Any operational expenses falls under the category of working capital. And then you have your tenant improvements. So if any deal that involves any type of construction or technical assistance, or you have leasehold improvements, there's usually contingencies in place for both the lender and yourself, really just to protect everybody that is involved. Most lenders usually do a thing called fund control, where they want to kind of spearhead the whole project. Most organizations, like let's say you've already sought a loan and you've had contractors in place with someone else, and then you seek a loan for maybe working capital, most lenders won't touch the deal until the construction's already done, because they just don't want it to get a little muddy in the sense of what happens if you might need a little bit more money. There's delays in you opening your business for them to fund, give you the working capital piece portion that you need in order to generate the revenue in order to pay back and service the debt. And that's ultimately what it all boils down to. And really just understanding, the amount of time it takes for in accruing this debt, whether it's short term or long term. And typically a lot of these things are covered in projections. Most lenders seek 2 to 3 years projections. Easier broken down monthly. I do see a lot of annual projections, but it's easier if we see that breakdown. Just it makes it a little bit more clear for the underwriter to really understand what goes into your project. Not all lenders are the same. Every lender has their own internal credit policy, what we call their credit box. So what that does is really determines the lender's appetite for risk. They'll put things in place like obviously a minimum credit score is the most popular, just a little soft screen to see if you're a good candidate to get another loan. Collateral requirements, some lenders will want to see that you have a large asset with value in it to back the loan, and obviously time of business and industry experience is all factors, and every lender is different. For my organization in particular, we don't have any collateral. Well, let me rephrase that. Collateral requirements isn't a prerequisite in our loan decisioning. So we're not expecting you to have a large asset in order to secure the loan. We do have a minimum FICO score of 670. We used to not have one, but due to recent changes, we had to really pivot the way that we did a soft screen. Whether you're working with myself or any other lenders, a bank, just really understand what goes into their credit box and their risk tolerance. Explain your situation, and don't be shy in terms of, if you've had hiccups in your credit in the past, it's okay. Some lenders take the story into account and really understanding the why, versus, just kind of seeing what they see and ruling you out. It's all about risk management at the end of the day. So if a lender could find a mitigant, then you might be good to go. We get that life happens. Some things are taken into account. Maybe you've had a loss in a family or a really bad injury that caused you to accrue a lot of debt, bad debt, charge off, etc. Now, while that, for the most part, in full transparency, it may hinder your chances of getting lending, at least you will know what you need to do to prepare to be okay and get you in the clear to become a good prospect to receive a loan. Credit, the big C. We all know credit. In order to borrow, you have to borrow. Not having credit is the same as having bad credit. So most lenders, whose credit do we review? For a business loan, anyone with 20% or more ownership in the business. For a business loan, you can't traditionally just get a co-signer and say, hey, okay, I know my credit is bad. Can I just bring my cousin to be a part of the loan? For business loans, it doesn't quite work that way. Anybody with 20% or more ownership in the business needs to personally guarantee the loan. Any stake less than that, they don't have to, but there may be certain situations where they still might have to if they're a key employee, or have the industry experience that would make the lender more comfortable in giving you the business loan because they see somebody on there with the capacity or the history to show that they've been in the industry to service the debt for said industry. A lot of lenders will take into account the spouses of the business owners. I know for us, we look at the whole household. Reason being is, let's say, you have a husband and wife in this example. One happens to be the breadwinner, or happens to be the breadwinner, and then the other spouse is the one wanting the loan. In the event that the quote unquote breadwinner might lose their job, we want to know that now you individually have the income to service the debt you already had, in addition to the debt that we gave you, and that we're not putting you on the hook for this large loan. So we do take into account the spouses for the most part. There are usually three things where we don't is if they have no role in the business, their income isn't contingent on servicing the household debt, as I just explained, and they aren't working in the business. So no role, no working, their income isn't needed to service the personal living expenses. Um, what is usually reviewed is the repayment history, obviously, the percentage of revolving debt available. A good rule of thumb is to keep it around 30 to 33%. Leverage, length of credit history, and the type of debt that's outstanding. Home loans, auto loans, student loans. I know you've heard the term good debt and bad debt. Typically, that falls under like student loans, because the rates are typically more favorable. You can defer them, and just you're going, we know the reason you have it. It was for a good cause. It wasn't something that you were using to mismanage finances, etc. So I know I touched on the first C, but these are the other C's of credit. So we have capacity, which is the financial ability to pay the loan back. Capital, you use your money invested in your business, often a down payment, or some sort of type of equity injection. Collateral, the asset you pledge to back the loan. Conditions, the market analysis and trends of the industry. And this is the most important, character. Credit behavior, and this is typically determined by looking at your report. If there's, it's no different than you having a relative and you've lent them money in the past and they take their sweet time giving you those funds back. And if they come back asking for more money, are you going to give them more? Probably not, because they've shown a history of not paying you back when they said they were. It's no different when seeking a business loan or a conventional loan. Capacity, and I touched on this earlier, but cash flow is king. For most lenders, in particular startup businesses, we want to see that you have the outside income to essentially cover your personal living expenses. Any personal living expenses, meaning, your rent if you got it, your car note if you got it, groceries, bills, etc. Typically we see those kind of things in looking at your tax return and the AGI, adjusted gross income. But in terms of just overall cash flow, we want to see that you can cover your debt service. For those unfamiliar with the term DSCR, that stands for debt service coverage ratio. Again, this goes back also to understanding credit boxes, because every lender has their own DSCR that they want to see. Some lenders might do a 1-to-1, a 2-to-1, 1-to-1, 1.75. And this ratio term means for every dollar of debt that you accrue, we want to see a dollar income to match it. So when you hear one-on-one debt service coverage ratio, that's what that means. Every dollar debt, there's a dollar coming into it to cover it. Projected income for new businesses or those planning significant expansion. Again, projections is important for this part, and having strong projections. Every now and then we'll see aggressive projections, and who are we to tell you what you can or can't do? But you just want to make sure it's reasonable. Obviously, for a startup business, lenders are gonna might side eye you if you put that, your business is selling, I don't know, pencils, and then you have your model, your projection showing that you're gonna do 1 million in a year. So you want to make it make sense. Um, so understanding your projections and what goes onto it is really important. There are small business development advisors nationwide. Obviously, here in Virginia, there are a few. Typically, you go to your local university or community college, and they have advisors there where they'll work with you hands on putting your projections together. So again, cash flow is king. In addition to income, having reserves on the back end is also important. We want to see that you have a safety net to fall back on in the event of any cost overruns or any emergencies or a rainy day, not even just particularly pertaining to your business, but for yourself as well. Again, life happens, and it's a good way of protecting yourself and the lender, because we all know businesses don't always hit the ground running, right? So this way, by you having something to fall back on, allows the lender to be a little bit more comfortable. So I always like to highlight saving in the early stages of entrepreneurship. Most of the times, too, if you are a startup, you're going to be required to put down some sort of down payment, an equity injection. So for us, excuse me, we like 10% of your loan or of the project as a down payment. So if your project requires 100K, we would need to at least see that you've put in 10,000 into the loan, and we would fund you to 90,000. However, one thing that sets us aside is we're able to use any funds that you've put into your business endeavor in place of that. For example, I had a client out in Detroit, couple that wanted to start a food truck business, and they already had purchased a truck for about 7 to 8 thousand, and I was able to use that as that equity injection, and they didn't have to come out of pocket money or come out of pocket any further. Again, on the flip side, you want to show that 10% of your loan request in reserves, and it isn't money that has to be given to us or the lender. It just needs to be seen, and it has to be liquid, easily accessible. It can be in investments. 401ks are fine. We obviously don't want you to touch it because there are taxes and penalties that are involved if you aren't of the retirement age. But it is something we can use to mitigate that post-injection liquidity. Character. Anyone with 20% or more ownership in the business, spouses, co-signers, not obviously for business owners that I said, but just in general, this is what obviously is looked at. Credit score, what goes into it is the payment history, percentage of revolving debt, late pays, charge off. So all those things are looked at by lenders to assess the character of the borrower. And obviously just having a conversation with the client or the borrower, you can really kind of get a good grasp of how serious they're wanting to take this journey of entrepreneurship. I like showing this slide. It's a really good breakdown of kind of what goes into and understanding the credit score, really understanding what hurts it. Obviously missing payments, late payments, credit cards. You never want to max out any lines of credit. Sometimes closing cards could hurt it if you close it too quickly, just because it lowers the your revolving debt capacity. It doesn't show you have multiple lines. Opening up in a short amount of time. I'm sure you've heard anytime you do a hard pull, you lose X amount of points depending on who's pulling the credit. So if you keep doing multiple, your score is going to start taking multiple hits and ultimately land you in a place where it's difficult to get lending because of that. Things that affect the score: income, length of residence, length of employment. Percentages of what makes it up. 35% of it is the payment history. So it's really important that you don't have if you're a day or two off, it's not the worst. The key here is not letting a report late. That's what it all boils down to. Every borough is different. So you want to understand when they report it. So, if you've been in a bind and you've been maybe a week out of your payments, it's not the end of the world. Even if you've been 2 or 3, now I'm not advising you obviously to take your time, obviously pay it back when you can, but it impacts your score when the borough is then recapturing or refactoring what has gone into it on a month-to-month basis, typically 30 to, I want to say 36 days. But again, every borough is different, so you do want to pay attention to that. Capacity, and that goes into obviously not maxing everything out, because it just shows that it can show irresponsibility, or desperation and go into it. Obviously, we want to get the story out to behind what is all going into using your revolving debt avenues so much. Length of credit, again, having no credit is just as bad as having bad credit. We have nothing to really measure your capacity to service any debt without seeing any credit. So sometimes you want to get like a secure credit card to build up your credit if you don't have any, where you're given a manageable amount, and then you just pay it off. You use it for like gas, groceries. You just pay it off so you don't have any interest on a month to month, and let it report so that it shows that you have a card and you're growing and building your credit. All right. And then obviously the things you can do to improve the score is pay down your credit cards. Don't close your credit cards so soon, but you still can't close them. But just don't do it so soon. More of a good technique is to pay cards down to zero and just leaving it, because what that does is it shows that you have the ability to take on that debt, but you're not essentially going, you don't need it, but you have access to that. Lenders like to see that, okay, well, he has, they could use this, but they don't want to. So maybe they're in a good position where they're not always needing to access debt to get by. Another trick also is doing a balance transfer if you're in a manageable position, because what that does is boost your credit limits, but taking those funds over to that one is showing that you've just kind of extended your line. Um, Typically there is a small charge when doing that, and you got to really pay attention to what credit card companies are offering that, or what promotions, etc., that goes into that. So I'm not going to touch too much on this topic here. Reason being, we just recently found out that the SBA is doing away with the scoring model. But a lot of folks, even I haven't heard about this prior to working here. The SBSS score, and think of a score that the SBA uses that ties into your business history, but mainly driven on your personal credit score. So I can usually tell an SBSS score isn't going to be good if their personal credit score isn't, because it's mostly driven by that. It's usually it ranges from 0 to 300, and right now the SBA wants them to be at 165 in order for the lender to move forward with them. But it takes things into account: your business credit history, time in business, risk level of the business, and again, your personal credit history is the main driver in this. If you're a startup, obviously there's no business history to go off of, so it's going to be the personal credit that ties into this. Right. Capital funds the business owners will put into the business for this project. So savings, you could use a home line of equity line of credit, so you can borrow against your house to use the funds to fund. Partners contributions, gifted funds are used. Even grants can be used, and I guess most lenders usually ask for 10 to 20% of an equity injection. Just really shows the lender that you're putting skin in the game. Just shows again that you're taking this seriously. You've done your due diligence, you've saved up, and you've already kind of made some headway in taking that next step in your business endeavors. Conditions is important. Typically they want to understand what the primary borrower or the operators have, or experience they have in said industry. It'd be challenging for me to say I want to open up an auto body shop, whereas I've never changed an oil or changed a tire a day in my life, something like that. Or saying, I want to start my own restaurant, but I've never cooked. So, but can I get a loan for 200,000 to open my restaurant? So it has to make sense. Not to say that and I don't want to be discouraging in a sense, like if it's something that you've always want to embarked on, but you've never had a chance to do, and now you have the opportunity, that wouldn't essentially hurt you, because we could use indirect experience, um, manage any type of management you had in previous roles, any maybe accounting practices, any marketing, anything that could translate to successful business ownership could also work. Again, it's contingent on what the lender usually requires that goes into what they're looking for. And also contingent on the industry in itself. If it's something that's high risk, that may be looked at a little bit deeper. If it's something that they can get by with other experiences that you had in the past, you might be okay there. But then it's what skills or abilities that allows you to successfully operate this business. Another thing that goes into it is the economic conditions that affect your industry. Lease terms, does a location matter? Is it contingent on you actually generating revenue to pay back the business loan? Doesn't matter if are you a home-based business, things of that nature. All these things are taken into account when assessing your risk capabilities. Collateral, another big C. We all know collateral is just having something to secure the loan that you are seeking. Tangible asset that could be sold by the lender in the event that you can't repay back the loan. Obviously, typically a house or a property to secure it. SBA SOP loans required not for real estate must aim to be fully secured. So 504 loans typically obviously involve the space that you're seeking a loan for. But we know the common forms of collateral to be house, cars. UCC business filing typically is a lien on a business asset. So any inventory, equipment owned by the business, any business vehicles, things like your printers or fax machines, a lender can go after in the event that you can't pay back the loan. A lot of obviously the collateral is contingent on the value to secure the loan. A lot of times if you're wanting a loan for X amount, you want to make sure that whatever it is that you're pledging as collateral has the value to secure what you're asking for. A lot of times you won't get lent the amount that you're seeking if the collateral isn't up to par with what you're seeking. And I touched on this, projections and business plans, obviously defend the numbers, so days and hours open that go into it. Average number of sales in an hour, days, month, payroll, operating expenses, utilities, insurance, rent, etc. All these really go into it. Business plans, good rule of thumb for your business plan is to have a good executive summary, a good marketing summary in there, and obviously just a general overview of what entails of the business. All right. And here I just want to share a few success stories that I've done. Not sure what levels or stages you all are in terms of, your business. Again, my bread and butter is working with startups. So we can also do business acquisitions, help out franchises, existing businesses in need of existing capital, things of that nature. So this deal I enjoyed working on. As I stated before, I am nationwide, so they were based out in New Jersey, and they formed a kind of like, think of DoorDash or Uber Eats for pharmacy prescriptions. So I thought it was a really neat idea. They weren't asking for a whole lot, but it was just a way for them to, get the prescriptions needed to you without you having to leave your house. You can get it delivered to you. So I thought it was a great concept. I like to think of my role as like a walking Shark Tank judge. I'm constantly hearing a lot of neat ideas, and it's truly amazing just the creativity that goes into some of these. And even if it's something that's already been done, they always say no idea is usually made from scratch. It's really just kind of take the wheel and figure out how to reinvent it or reinvent yourself. So this is one good success story that I really liked the wanted to share. This one here was a startup business down in Georgia where they built like an online training platform for um, for folks kind of needing to get in that job space, not necessarily recruiting, but just a platform where it helped groups get into spaces where they traditionally were challenged, or just really prep them in terms of getting those opportunities awarded. So this was also a really good concept. We were able to lend them $150,000. All right. And here's my contact for you all. Please don't hesitate to reach out. Happy to speak to anybody regardless of where they are, if it's strictly information based, if they just want general knowledge in terms of what is needed or what is required or what we're seeking. Floor is, I'm always open to seeing how we can be a resource. So again, thank you for having me, Sam, and I'll leave the floor up to you all for questions. Because I was sharing the screen, I wasn't able to see any questions pop up, but I'll go ahead and unshare.
Well, thank you, Darryl. That was a very good, informative, and well put together presentation. They answer a lot of basic questions and then kind of build from there. So really appreciate you. That's one of the best presentations we've had on our webinar. So thank you. We do have a couple of questions, and then we have some of our own. The first one is from Tiana Washington, and her question is there such a thing as taking on funding too early, even if you qualify? How do you know when debt could actually hurt your business? And there we go. That's the question.
I think we lost him.
Oh, yep, I think we did. Okay, well, look, it was a great presentation. And we always do another one if people have questions out there. But right now, I guess we will close out. So we appreciate Darryl's time, energy, and valuable knowledge. And this concludes today's webinar. Thank you, everyone, for joining us today. And as Darryl indicated, please don't hesitate to reach out to him for additional information or assistance. Also, please feel free to complete the survey that you'll see pop up once you sign off. And if you don't get a chance to do that, a link to the survey will also be emailed to you. Please note that the next webinar series will happen on February 12th at 1 p.m. and it's titled Powering Business Growth Through Commercial Credit. Our presenter will be Rob Caro of Industrial Bank. Take care and goodbye for now.